Welcome to the Deep Dive. You're tuning in because, well, you want to get a real handle on things quickly and thoroughly.
Yeah.
Today, we're aiming to give you a direct path to understanding a really foundational approach in investing.
Benjamin Graham's strategy.
Exactly. For picking stocks, specifically for you, the enterprising investor.
That's right. We're going beyond just the general ideas of value investing here.
Right.
We're getting into the nitty-gritty of how Graham thought someone like you could, potentially earn better than average returns.
By carefully selecting individual companies.
Mm-hmm.
Okay, so our goal today is pretty straightforward. We want to unpack a really crucial part of Graham's work.
We'll look at his sort of initial doubts about easily beating the market.
Yeah, the evidence he brought up.
Which is compelling, and most importantly, those specific methods, sometimes a bit unconventional, that he suggested.
For those of you willing to put in the extra work, right?
Exactly. This isn't about quick wins.
No, definitely not. It's about a well-thought-out plan. Okay, let's dig in.
So Graham starts with something that seems like, well, common sense.
Right.
Shouldn't investors who really know their stuff, who do the homework, be able to outperform the market averages like the Dow?
Yeah, I mean, just getting the average return seems like the default, doesn't it? Surely you can aim higher with some effort.
You'd think so. But then, comes the reality check.
Uh-huh.
Graham looks at the actual track record of investment funds, these mutual funds.
Packed with professional analysts, sophisticated research.
All the resources. And the surprising truth, frankly, was that over the long haul, many of them didn't even manage to beat the broad market averages.
Like the S&P 500.
Exactly. He even mentions a study, I think it was 1960 to 1968.
Yeah.
It showed that randomly chosen portfolios of stocks just picked from the NYSE list sometimes actually did better than the mutual funds with similar risk levels.
Wow. Okay, so what does that imply for our listener?
Well, it suggests that even with all that expert management, consistently beating the market is a genuine challenge. You might need a different angle.
Okay, so why? Why is it so darn difficult? Graham gives a couple of really insightful reasons.
Yeah, first he touches on something like the efficient market theory.
Right.
Which, simply put, suggests that current stock prices already reflect all the known information and, reasonable future expectations.
So if that's true,
Then any price changes after that are mostly unpredictable, makes it incredibly tough, even for skilled analysts, to consistently pick winners.
okay, that makes sense. What else?
And then just think about the sheer number of analysts out there.
Yeah.
Hundreds, maybe thousands of really smart people all looking at the same companies.
So the price ends up reflecting a kind of consensus.
It seems logical, yeah. It makes it very hard for any single analyst to find some unique insight the market hasn't already baked in.
He uses that analogy, right?
Yeah.
The bridge players.
Oh yeah, the master bridge players at a tournament when everyone's an expert.
The winner might just be down to luck.
Pretty much, especially since they all basically know the same strategies and information within the profession. And Graham also points out a potential, let's say, blind spot in how many analysts work.
Which is?
This tendency to chase high-growth companies almost regardless of price.
Okay.
And to just dismiss companies that seem less exciting, again, no matter how cheap the stock might be.
Right, but businesses go in cycles, don't they?
Exactly. It overlooks that cyclical nature. Very few companies grow super fast forever, and it's also pretty rare for a large company to just disappear completely.
Okay, so with all these challenges, was Graham just saying, forget it, you can't beat the market?
Not quite. And this is where it gets really interesting for you, the listener.
Uh-huh.
He suggests opportunities might exist in parts of the market that are, overlooked or unpopular.
Precisely because the standard ways of analyzing stocks often ignore them.
Yes. But he stresses to profit from these situations, you need specific, often unconventional methods.
Approaches that go against the Wall Street grain.
Which, as the data suggested, wasn't consistently delivering superior results anyway.
So what did these unconventional methods look like? He gave examples from his own firm, right? Graham Newman.
He did. He gives us a look inside Graham Newman Corporation, what they were up to between, say, 1926 and 1956.
And these weren't just buy and hold strategies.
Definitely not. They included things like arbitrages.
Okay, what's that?
That involved buying one security and simultaneously selling a related one during a company reorganization.
Aiming for?
A pretty significant annual return, like 20% or more, with a high chance of success, maybe 4 out of 5 times.
Wow, okay. What else?
Liquidations. Buying shares in companies that were selling off assets and distributing cash.
Similar targets, high returns, high success rate.
Yeah, same kind of target profile.
Yeah.
Then there were related hedges.
Hedges. guide.
Buying convertible bonds or preferred stocks and then selling short the common stock at parity,
Parity meaning,
meaning the price where the bond could be converted into an equivalent value of common stock.
and the goal there.
To profit if the common stock price fell more than the bond or preferred share price did.
Interesting. And the famous one, bargain issues.
Ah, yes, the net current asset or bargain issues. Buying stocks for less than their net liquid assets alone.
So ignoring buildings, equipment, all that.
Exactly. Often at 2/3 or less of this basic value. But he really stressed, if you use this method
Diversify.
hugely across at least 100 different stocks.
Got it. Did they ever stop doing certain things?
They did. He mentions they stopped buying companies that looked attractive but were trading above their working capital value.
Why?
And also unrelated hedging. Graham found they just weren't reliable enough for profits and caused too many headaches.
So they shifted focus.
Yeah, from about 1939 onwards, they really concentrated on those self-liquidating situations, related hedges, the working capital bargains, and sometimes gaining control of companies.
And that worked better.
He said it consistently produced satisfactory results. Plus, the related hedges were a nice buffer in down markets.
Okay, let's fast forward to 1971, when Graham was writing this edition. He knew those specialized techniques weren't for the average defensive investor.
Right.
But what about you, the listener, the more active or enterprising investor of that time?
For you, Graham suggested exploring a wider range of securities.
Ones that weren't obviously overpriced by conservative measures.
Exactly, and maybe looked more appealing than the average stock because of their prospects or their track record.
But still keeping an eye on quality and price.
Oh, absolutely. Similar tests to the defensive investor, just maybe a bit less rigid, more flexibility.
So, for instance, you might consider a company even if it had a temporary setback, like a loss one year.
Yeah, if the overall fundamentals still looked strong. He also suggested focusing on industries and companies you felt optimistic about.
But there's always a but.
A big but. He strongly warned against letting your enthusiasm make you overpay.
Classic Graham.
Indeed. And he even pointed out potential in buying cyclical businesses like steel companies, for example.
When they're out of favor.
Exactly. When prices are low because everyone's pessimistic, the key for you was to think differently, see value where others didn't.
Okay, this leads us to how you might actually find these potentially attractive, maybe smaller companies.
Right. He suggested looking for companies with good recent performance, a decent past record, but ones that just haven't really caught the public's eye.
He mentioned LTRA and Emhart as examples back then.
Yeah, and this is where, again, gets really practical for you. He introduces the Standard & Poor's Stock Guide.
As a tool for this kind of research.
A really useful tool. What's fascinating for you is that this guide, even back then, had tons of summarized financial data.
On thousands of companies, right?
Well,
Not just the big names.
Over 4,500. It had price histories going back years, dividend records, earnings, financial health details. A real treasure trove for someone willing to dig.
Although he did note one thing missing.
Yeah, he wished it included the net asset value, or book value per share. You'd typically find that in more detailed S&P reports.
But still, you could really get into the numbers, look at highs and lows, dividend histories, the big differences in PE ratios.
It paints a picture of just how diverse the stock market landscape was for you.
So how would you use this guide? He walks through a filtering process, right? A winnowing.
Exactly. He starts by looking for stocks with a low price-to-earnings ratio.
What was the threshold?
9 or less, based on the data at the end of 1970 in the guide. He then just takes the first 20 companies that pop up as a starting sample.
And he points out this initial list might not look amazing. Lots of low-price stocks.
Yeah, half were under $10. But he emphasizes, for you, the enterprising investor, that's not automatically bad. It just means more digging is needed.
Okay, so then the crucial step, applying more criteria.
Right. Similar to the defensive rules, but less strict. Things like
Financial condition.
sound finances, current assets at least 1.5 times current liabilities, and debt not too high relative to net current assets for industrial companies.
Earning stability.
No losses in the last 5 years.
Dividends.
Paying some current dividend.
Growth.
Last year's earnings higher than back in 1966.
And price relative to assets.
Price less than 120% of net tangible assets.
Okay, 5 extra filters. What happened to the initial list of 20?
Narrowed down to just 5.
Wow.
But then Graham expands the search, looks at the first 450 companies in the guide, and finds 15 stocks meeting all 6 criteria. He presents that as sort of an illustrative portfolio for you.
Just an illustration, though.
Absolutely. He makes it clear, if you applied this filter to all 4,500 companies in the guide,
You might find quite a few.
maybe around 150 meeting all criteria. That gives you a much wider pool to choose from for your own deeper analysis.
He also mentions those S&P earnings and dividend rankings.
Yeah, based on stability and growth over the past 8 years, important, not based on price.
And how did his sample portfolio stack up?
Many had average or better rankings, suggesting a baseline quality. He even floats adding a 7th criterion, only considering companies ranked average or better by S&P.
And you'd still have choices.
Potentially still around 100 options. His main point for you is a group of reasonably good companies meeting solid financial tests, selling cheap relative to earnings and assets, that should offer promise.
Okay, that leads to a natural question, doesn't it? Could it be even simpler?
Right. Could just one rule work, like just buy low PE stocks or high dividend yielders or stocks with big asset values?
Graham looked at that. He said, historically, 2 single criterion methods had done well long term.
Yeah, buying low multiplier stocks of major companies like those in the Dow Jones Industrial Average, and buying a diverse group of stocks selling below their net current asset value, the bargain issues again.
But he added a caveat, right, about recent performance.
He did. He noted the low multiplier DJIA strategy hadn't worked so well in the period just before he was writing, say 1968 to 1971.
And the bargain issues.
They'd become much harder to find over the previous decade or so. The market was changing.
So this led him to do some experiments.
Yeah, looking at 30 stock portfolios chosen based on single criteria. Bought at 1968 prices, see how they did by 1971, using stock guide data.
What kind of criteria did he test?
All sorts. Low PE ratios, high dividend yields, really long dividend payment histories, huge company size, strong financials, low price per share in dollars, low price compared to previous highs, and those high S&P quality ratings.
And it's interesting that the stock guide had data for all of those.
Yeah, it shows what factors were considered important for analysis back then. Graham, of course, wished net asset value was in there too.
So what was the big takeaway from these experiments?
One really striking finding for you. Randomly picked stocks performed terribly.
Worse than the indexes.
Significantly worse than the S&P and the Dow during a time when the overall market was pretty flat.
Why did Graham think that happened?
He figured smaller, lower quality companies tend to get overvalued in bull markets. Then they fall harder and recover slower.
So the lesson for you, the enterprising investor.
Be really cautious about second-tier companies unless they are genuine, clear bargains.
Makes sense. Any other notable results?
Well, the highest-rated industrial companies, the A-plus ones, did better than the S&P industrials and the Dow.
Okay.
Very large companies performed about in line with the indexes. Stocks over $100 showed a small gain.
And those S&P quality rankings seem to hold up.
Yeah, generally higher rank meant better performance in this specific test period.
What about that test using book value? The one not in the stock guide? That had a weird result, didn't it?
It really did, especially considering Graham's usual focus, the goodwill giants.
Companies where goodwill was a huge part of their market price.
Yeah, goodwill exceeding half their market price. They actually performed very well.
Which seems counter to the value philosophy.
It does. It suggested that momentum, strong, positive sentiment behind big, well-regarded companies with great records and growth expectations could keep pushing prices up even if they seemed high relative to tangible assets.
But Graham still preferred.
He still preferred companies where tangible assets were at least 2/3 of the market price.
So overall, did these single-factor tests support combining criteria?
Generally, yes. Lists based on a favorable factor, like low PE, tended to do better than lists based on the opposite, like high PE.
But the test lists overall didn't beat the S&P.
No, and Graham thought that was likely because the S&P index is weighted by market capitalization.
Meaning the biggest companies have the biggest impact.
Exactly. Those larger, more stable companies carried the index, highlighting their power. That's important for you to realize.
Okay, let's circle back to those bargain issues, the net current asset stocks.
Right. Graham explains why they weren't in those 1968-71 tests.
They were hard to find then.
Very scarce at the end of 1968. But, he points out, during the market dip in 1970, they became much more available. Many were trading below working capital value.
And Graham still believed in them.
Oh, absolutely. He emphasizes his long-standing belief, backed by decades of experience.
Except for the worst of the Depression years.
Right. His experience from 1923 to 1957 was overwhelmingly positive for a diversified group of stocks bought below net current assets, remember, ignoring fixed assets entirely.
And were they still relevant in early 1971?
Graham estimated there were still maybe 50 or more listed in the stock guide. Even if you screened out ones with recent losses, you could likely still build a diverse portfolio.
You give some examples, right, to show the disconnect between market price and assets.
Yeah, well-known names even, like Lady Pepperell, Janssen, Parker Pen, trading that or below net current asset value in 1970.
It highlights how the market can value things differently from the underlying assets or even brand names.
He quotes Pascal, the heart has its reasons that the reason doesn't understand, applying it to Wall Street's sometimes emotional behavior.
Contrasting it with the hype around low-quality new stocks and boom.
Exactly. But Graham reassures you, the enterprising investor, yes, these bargain issues can work.
If
you buy a diversified group and exercise patience, even if they don't pop right away.
he gives that Burton-Dixie example.
Right. Bought at $20.64 when net current asset value was $30, book value $50.
Took a few years.
Yeah, but shareholders were offered $53 in 1967. A very nice annual return for those who waited. He also mentions National Presto Industries as a current example at that time.
Okay, one last area Graham touched on for the enterprising investor. Special situations.
Well, workouts, yeah. Another potential hunting ground.
These involve specific corporate events.
Like mergers, acquisitions, liquidations. He gives 3 examples from early 1971.
Kaiser Roth and Borden's.
Yeah, a proposed stock swap acquisition. He outlined the potential profit and annualized return,
But also the risk it might fall through.
which it actually did later. Then there was Aurora Plastics and National Biscuit Co.
A cash offer.
Right. Again, potential profit, but risks about timing and completion. That one got renegotiated at a lower price, affecting the return.
And the third.
Universal Marion Co. doing a liquidation looked like a potential profit based on cash distributions versus the stock price. But after an initial payout, the stock price fell, casting doubt on the final outcome.
So the conclusion on these.
Probably not for casual involvement. Randomly jumping in likely isn't attractive. It's really a field for experienced professionals.
Though he added that interesting side note about Kaiser Roth later.
Yeah, after the deal fell through, the stock dropped way below the original offer price, which made you wonder.
Mistake by management. Or was the market undervaluing it?
Exactly. Something for a sharp security analyst like you, the listener, to potentially investigate further.
Okay, so let's wrap this up. For you, the enterprising investor, what are the key takeaways from Graham here?
Well, first, acknowledge the real challenge of consistently beating the market. It's not easy.
Right, and because of that,
You need unconventional, disciplined strategies. You can't just follow the crowd.
look for potential rewards in neglected areas.
Yeah, like those net current asset bargains or maybe special situations if you have the expertise. But always be mindful of the risks.
Okay, we hope this deep dive has given you a solid framework for thinking about selecting individual stocks.
Highlighting both the significant hurdles and the potential paths Graham laid out.
Especially for those of you willing to take that more active, thoughtful, enterprising approach.
Big Zach.
And with that, maybe here's a final thought for you to chew on. Graham was writing decades ago. Financial markets have evolved a lot since then.
Think about the rise of intangible assets, technology, globalization, things mentioned even in the commentary to his book.
So how might you adapt or reinterpret Graham's fundamental principles for enterprising investors to navigate the complexities of today's world?
That's a great question. Definitely something worth exploring further on your own.
Absolutely. Thanks for taking this deep dive with us.